All right, let's dive right in. Today, we're taking a look at the U.S. commercial real estate market for 2025. And look, this isn't just a simple story about recovery. No, what's happening is way more interesting. We're talking about a massive, fundamental shift, what we're calling the Great Rebalancing. It's a total transformation that's literally redrawing the map of who's winning and who's losing across the entire country.
So you're hearing this phrase everywhere, right? That the market has turned the corner. And yeah, there's definitely a feeling of cautious optimism out there. I mean, you look at the surveys and something like 70% of investors are planning to buy more property in 2025 than they did last year. So clearly they're seeing opportunities. But here's the thing. The real question isn't if we've turned a corner.
It's about what kind of world we're turning into. And let me be really clear about this. We are not going back to the way things were before. No way. We're stepping into a totally new era, one that's being defined by this phrase you're going to hear a lot: higher-ish for longer interest rates. Now, this isn't just some technical jargon for the finance nerds. This is the fundamental force that's splitting the entire market in two.
Okay, so let's get into it. First up, the sector battlegrounds. And honestly, it really is a tale of two completely different markets. Right now, what you're investing in has never mattered more.
So on one side, you've got this massive office hangover. We're talking about national vacancy rates that are just stubbornly stuck up high, somewhere between 14 and 20% depending on who you ask. And it's the older buildings that are really getting hammered, while everyone wants the shiny, new, high-quality spaces. But then you flip the coin and it's a completely different story. You've got the ongoing boom in apartments, multifamily, and warehouses, or industrial. They are still the absolute darlings of the investment world, simply because demand is just relentless. And hey, you don't have to take my word for it, just follow the money. This chart tells the story perfectly. Almost half, a full 48% of all investor interest, is aimed squarely at multifamily apartments. That's the dominant play, no question. Industrial and logistics, well, they grab another big chunk, about 24%. But here's where it gets interesting. You start to see this little hunt for value emerging. Yeah, it's smaller, but the fact that there's any new interest in retail and even the battered old office sector, that tells you some investors are starting to sniff around for a bargain. And speaking of retail, it's not dead, not by a long shot. It's just adapting. It's fighting back. First, they're all about experiences now. Things like in-store events or special services you just can't get online. Second, they're finally mastering that omni-channel thing, making their physical stores and their websites work together seamlessly. And third, the really smart shopping centers, they're built around essential businesses, like a big grocery store that will bring people in week after week. Okay, so that's the what people are buying. Now let's talk about the where. Because this massive search for growth and affordability is literally redrawing the real estate map of America as we speak. For years, the only story anyone wanted to talk about was the Sun Belt. Cities like Dallas, Miami, Phoenix, they were on fire. And look, they're still pulling in a ton of investment, but now they're facing this weird paradox. They're almost becoming victims of their own success, creating huge new problems like affordability crises and serious climate risk. But while all that's happening, this other, quieter story is playing out, a Rust Belt renaissance. Suddenly, because it's so affordable, you're seeing this surprising comeback in smaller, secondary cities that, frankly, most people had written off. And if you want proof, just look at this data. Get this. The cities with the top year-over-year rent growth, it's not the places you'd expect. It's Allentown, Pennsylvania, Columbia, South Carolina, Lexington, Kentucky. I mean, wow. This is that secondary city renaissance happening in real time. It's the hard proof that this hunt for affordability is pushing growth into some pretty unexpected corners of the map.
But despite all these interesting pockets of growth and these new opportunities, the entire market is staring down one enormous headwind. This right here is the ultimate challenge for 2025 and beyond. It's about confronting what everyone in the industry is calling the wall of maturities.
Yeah. Lurking behind every single thing we've talked about so far, behind the rebalancing, behind every deal, behind every forecast, is the market's single biggest challenge. And that is a massive, almost unprecedented wave of debt that's all coming due at once. So the big question is, just how massive are we talking here? This $1.1
trillion with a T. That's the estimated value of commercial real estate loans that have to be paid back or refinanced in just the next 2 years. And here's the absolute kicker. Most of this debt was taken out when interest rates were basically zero. Now, all these property owners have to go back to the bank and get new loans in this high-ish for longer world. We're talking about borrowing costs that could literally double or even triple, almost overnight.
And don't think for a second this is just an office building problem. It's not. If we just look at the securitized part of that debt, the loans that get bundled up and sold off to investors, you can see this pain is spread all over the place. Sure, office has the biggest slice at $64 billion. But look, multifamily is right on its heels at $61 billion, and hotels are facing a huge wall of their own. This thing is hitting everybody.
So this whole situation creates a really serious problem. A lot of these properties are now what we call underwater. That just means the amount they owe on the loan is actually more than what the property is worth today. And for about 14% of all the loans coming due in 2025, that's the tough reality. For those owners, you can't just go and refinance. It's not an option. And that, right there, could trigger a wave of forced, distressed sales, which of course is a huge opportunity for investors who are sitting on a pile of cash.
Okay, so with a huge challenge like that, wall of maturities hanging over everything, you have to ask, where are the smart investors, the innovators, actually finding opportunities? Well, that brings us to the future of all this. These really interesting niche plays that are popping up around very specific, very powerful new trends. So we're looking way beyond just offices and apartments here. A whole new world of hot sectors is opening up. We're talking about data centers, labs for life sciences, housing for seniors and for students, and then you have this one that always surprises people: industrial outdoor storage. Yeah, it's basically just giant parking lots for trucks and equipment. But it has become this incredibly hot commodity, mostly because it's so hard to get the permits to build new ones. But the absolute, undisputed rock star of all these niche sectors, it has to be data centers. The market is projected to grow at a staggering 14% every single year. I mean, to put that in perspective, that means the entire market will basically double in size every 5 years. It's just explosive. And it's all being fueled by this bottomless demand from AI and cloud computing. Think about it. Every time you ask an AI a question, stream a movie, save a file to the cloud, all that data has to live somewhere physical. And that physical home, that's the new gold rush in real estate. So there you have it. The 2025 market isn't one single story. It's a story of a massive split, a divergence between sectors that are thriving and sectors that are just struggling to survive. It's a story of the booming Sun Belt hitting new problems while the forgotten Rust Belt finds new life. And it's all happening under the shadow of this enormous wall of debt, but at the same time sparked by these incredible new niche opportunities. Which really, it all leaves us with one final fascinating question to think about. Once the dust finally settles from this great rebalancing, what will our cities and our workplaces actually look like in this brand new world?